Today, we're investigating a website that survived the dot-com crash. It survived Google's rise. It survived Facebook's dominance. It survived the largest data breach in internet history, affecting 3 billion people. It survived corporate incompetence so breathtaking that executives rejected $47 billion, then sold for $4.8 billion. Today, investors choose this site over Bloomberg, Google Finance, and every competitor. Teachers check their retirement accounts here. Day traders make million-dollar decisions based on their data. Financial advisors trust it with their clients' futures. The company that built it made every wrong decision possible. They turned down Google for $1 million when it could have been theirs. They rejected Microsoft's $47 billion offer out of pure arrogance. They covered up security breaches for years, lying to regulators and investors alike. Yet through decades of corporate disasters, one product refused to die. While everything else burned, it grew stronger. While executives walked away with golden parachutes, loyal users kept coming back. The story of Yahoo Finance begins with the most expensive mistake in internet history. But first, make sure you hit that like and subscribe button. We really appreciate it. In 1998, 2 Stanford students offered to sell their search engine for $1 million. Yahoo said no. Those students were Larry Page and Sergey Brin. Their search engine became Google, now worth over $1 trillion. Jerry Yang and David Filo had created the web's first popular directory in 1994. They organized the internet like a massive phone book. By 1998, Yahoo was the king of the early web, guiding millions through cyberspace. When Page and Brin approached Yahoo with their PageRank system, Yahoo's executives saw a problem. Google sent users to other websites to find information. Yahoo wanted users to stay and browse their categories, their news, their growing collection of services. Yahoo Finance was one of those services. Even in the late 1990s, it showed promise as something different. A utility people actually needed rather than a browsing destination they might abandon. But Yahoo's leadership missed the bigger picture. They believed web portals would dominate forever. Search engines were just tools. Why pay $1 million for technology that pushed users away from your profitable portal? 4 years later, Google gave Yahoo another chance. In 2002, CEO Terry Semel sat across from Google's founders as they asked for $5 billion. $5 billion seemed absurd for a simple search company. Semel walked away. Google went public in 2004. Their market value exploded past Yahoo's within months. While Yahoo's search engine faded into irrelevance, Google became the gateway to human knowledge. During this period of terrible decision-making, Yahoo Finance quietly dominated its corner. Free stock quotes, company financials, investment news, tools that worked without requiring users to browse categories or click through portal pages. Yahoo had stumbled onto something powerful, giving people exactly what they needed. But the executives were too busy rejecting billion-dollar opportunities to notice. February 2008, Microsoft offers to buy Yahoo for $44.6 billion. Yahoo's board calls it insulting. The offer was $31 per share, a 62% premium over Yahoo's closing price. Steve Ballmer believed a Microsoft-Yahoo combination could challenge Google's growing dominance in online advertising. "We have great respect for Yahoo," Ballmer announced publicly. The deal would create superior value to our respective shareholders. Yahoo's response was immediate. The company claimed Microsoft's bid substantially undervalues Yahoo. The board unanimously rejected the offer. Microsoft tried again. They increased the bid to $47 billion. Yahoo still refused. Jerry Yang, now Yahoo's CEO, led the resistance. He believed Yahoo was worth far more than Microsoft offered. The company had valuable assets, international operations, a growing advertising business. Most importantly, Yahoo owned a stake in Alibaba worth billions. But Yang missed a crucial detail. While he played hardball with Microsoft, Yahoo Finance achieved something remarkable. In 2008, the same year, Yahoo rejected $47 billion. Yahoo Finance launched free real-time stock quotes. This was revolutionary. Professional traders paid thousands for real-time data. Yahoo Finance gave it away free. The feature exploded in popularity among retail investors. Teachers checking their 401k accounts, retirees monitoring dividend stocks, day traders making split-second decisions, all relied on Yahoo Finance's free instant data. Yahoo's executives couldn't see value when Microsoft offered $47 billion, yet they accidentally created one of the internet's most valuable financial services. Microsoft walked away in May 2008. Yahoo's stock price collapsed. Yang resigned in disgrace the following year. Yahoo eventually sold to Verizon for $4.8 billion, $40 billion less than Microsoft had offered. But Yahoo Finance thrived during this corporate chaos. Users didn't care about boardroom politics, they cared about accurate stock prices and reliable financial data. Yahoo Finance delivered both free of charge. Yang's arrogance would soon pale compared to what came next. Hidden in Yahoo's servers, a catastrophe was brewing that would make the Microsoft rejection look like a minor error. In December 2014, Yahoo's security team discovered Russian hackers had stolen their crown jewels. They told no one. Not the users, not the regulators, not even potential buyers. The breach was massive. Nation-state actors had accessed Yahoo's entire user database. 3 billion accounts compromised. Every single Yahoo user affected. Names, email addresses, phone numbers, birth dates, security questions and answers, even encrypted passwords, all stolen by foreign intelligence services. But this was just the beginning. In 2013, a separate breach had already compromised 1 billion accounts. Yahoo knew about this too. They stayed silent for 3 years. Then another one a year later. This 2014 attack was different. Russian state-sponsored hackers specifically targeted Yahoo's systems. They went further than stealing data. They forged cookies that allowed password-free access to accounts. From 2015 through 2016, attackers could log into Yahoo accounts without knowing passwords. Yahoo's executives knew the scope of these disasters. Internal security reports documented the breaches. Senior leadership received briefings about the Russian attacks. Yet Yahoo continued filing SEC reports claiming they only faced the risk of future breaches. They never mentioned that massive breaches had already occurred. Meanwhile, Yahoo Finance users logged in daily. They checked stock prices, tracked portfolios, and made investment decisions. Millions of people trusted Yahoo with their financial information. None of them knew their personal data was being traded on the dark web. The cover-up created a ticking time bomb. Yahoo couldn't hide breaches affecting 3 billion people forever. Every day increased the legal and financial liability. But Yahoo's leadership prioritized short-term stock prices over user safety. They buried internal security reports. They misled investors in official filings. They gambled that nobody would discover the truth. Yahoo Finance remained popular throughout this crisis. Users didn't know about the hidden breaches, but they wouldn't have cared anyway. The platform provided essential financial tools that worked reliably. But the cover-up was about to explode in the most public way possible. July 2016, Verizon asks Yahoo about data breaches during due diligence. Yahoo hands them a spreadsheet listing just 4 minor incidents. The spreadsheet was a lie. Verizon offered $4.83 billion for Yahoo's operating business. They needed to know about security risks before signing. The Yahoo executives knew their entire database had been compromised by nation-state hackers, but they decided not to mention it. Instead, Yahoo filed official documents with the SEC announcing the Verizon deal. The documents contained sworn statements about their cybersecurity history. The company claimed no knowledge of major breaches. This was perjury on a massive scale. But by September 22, 2016, Yahoo could no longer hide the truth. They announced that 500 million user accounts had been compromised in 2014. Yahoo's stock price dropped 3% overnight, causing the company to lose $1.3 billion in market value in a single day. Verizon executives felt betrayed. They had asked specifically about data breaches. Yahoo had lied directly to their faces during months of negotiations. Then in December, Yahoo revealed another breach. This one from 2013. It had affected 1 billion accounts. The final revelation came in 2017, showing that all 3 billion Yahoo accounts had been compromised. Verizon demanded compensation for the deception. They threatened to walk away from the deal entirely. After intense negotiations, Yahoo agreed to reduce the sale price by $350 million. Yahoo literally paid $350 million for lying about the largest data breach in internet history. Throughout this chaos, Yahoo Finance users remained loyal. They didn't care about corporate scandals or boardroom deceptions. They needed reliable financial data, and Yahoo Finance delivered. Then in June 2017, Marissa Mayer, the CEO who oversaw the data breach cover-up, received a $23 million severance package from Yahoo upon its sale to Verizon. Mayer's golden parachute was called obscene by shareholders. Verizon completed the acquisition for $4.48 billion. They combined Yahoo with AOL under a new subsidiary called Oath Inc. The name would later change to Verizon Media. Verizon cut 2,100 jobs as they merged Yahoo and AOL operations. Their strategy seemed logical on paper. Combine Yahoo's content with AOL's advertising technology. Compete with Google and Facebook for digital advertising dollars. The problem was that Verizon was a telecommunications company. They understood cell towers and fiber optic cables. They knew nothing about running media properties. Yahoo Finance suffered under Verizon's ownership. The platform received minimal investments and attention. User complaints mounted about interface changes and reduced functionality. Long-term users watched their trusted platform stagnate. Features disappeared, loading times increased. The clean, simple design became cluttered with Verizon branding. But Yahoo Finance's core utility remained intact. Stock quotes were still accurate. Financial data was still comprehensive. The platform worked even if it wasn't improving. By 2020, Verizon realized their digital media experiment had failed. Google and Facebook dominated online advertising. Yahoo and AOL were losing money despite their massive audiences. Hans Vestberg, Verizon's CEO, made a difficult decision. The company would sell Yahoo and focus on 5G and telecommunications. The next iteration requires full investment and the right resources, he explained. Yahoo Finance had survived another corporate disaster, and the users still remained loyal despite years of neglect. September 2021, Apollo Global Management pays $5 billion for Yahoo, more than Verizon paid, and the smartest money in private equity doesn't overpay. Apollo manages $472 billion in assets. They specialize in fixing broken companies. When Apollo buys something, they see value others missed. Reed Raymond led the acquisition team. He saw what Verizon couldn't: Yahoo's hidden gold mine. Yahoo generated $8 billion in annual revenue, so maybe $5 billion was a steal. Within weeks, Apollo made their smartest move yet. They hired Jim Lanzone as CEO. Lanzone wasn't another telecom executive trying to understand media. He built CBS Interactive into a powerhouse. He ran Tinder during explosive user growth. His mission was simple: stop trying to be everything to everyone. Job number one is making every product super strong, Lanzone announced. Apollo wanted excellence, not mediocrity across dozens of properties. Yahoo Finance got immediate attention and investment. Mobile app optimization, premium subscription tiers, strategic acquisitions targeting retail investors. 2023 brought major acquisitions. Common stock connected social features with investing. Wagger expanded into sports betting markets. Yahoo Finance launched premium services for serious investors. Advanced charting tools, professional research reports, ad-free experiences. Traffic exploded under Apollo's ownership. The platform ranked number 14 globally for web traffic. More users meant more advertising revenue. Premium subscriptions added recurring income streams. Strategic partnerships created new business opportunities. Apollo's investment thesis was proving brilliant. They bought Yahoo for $5 billion. The company now generates that much revenue every 8 months. Yahoo Finance's success drove the entire transformation. While competitors charged thousands for financial data, Yahoo Finance remained free. Bloomberg terminal costs $24,000 per year. Yahoo Finance gives away better tools for nothing. Individual investors loved the accessibility. Professional traders appreciated the reliability. Financial advisors trusted the comprehensive data. Apollo executives had discovered something remarkable. Yahoo Finance wasn't failing, despite all the corporate chaos. It thrived because corporate politics never touched its core mission. The platform survived every disaster by focusing on user needs. Accurate data, fast loading times, simple interfaces that actually worked. Under Apollo's leadership, this focus intensified. No more corporate initiatives that distracted from serving investors. No more strategies that prioritized portal traffic over utility. Yahoo Finance became exactly what it should have been all along: the internet's premier destination for financial information. Free, reliable, and constantly improving. Today, Yahoo Finance serves 150 million investors monthly. For 25 consecutive years, no competitor has knocked Yahoo Finance from the #1 spot. Google tried, Microsoft tried, dozens of startups tried. They all failed because they missed the fundamental truth. Investors want tools, not entertainment. Teachers checking retirement accounts need accurate data, not flashy graphics. Day traders making split-second decisions need reliability, not social features. Yahoo Finance delivers exactly what people need, nothing more, nothing less. The platform survived corporate incompetence because great products outlast terrible management. User loyalty beats boardroom strategy every time. This is the lesson every entrepreneur should remember. Build something people actually need. Make it work perfectly. Everything else is noise. Were Yahoo's executives criminal masterminds or just terrible at business? Drop your thoughts in the comments below. And if this corporate survival story amazed you, hit that subscribe button and give us a like. Ready for another jaw-dropping business story? We think you'll love this next investigation.